Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Prerana, Seth, fixed income strategist. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. The latest bout of bond market underperformance has been spurred by the US Treasury yield curve steepening. This type of steepening, called the bear steepening, has been driven by higher long-term bond yields, where 10-year US Treasury yields have risen by almost 50 basis points, while the short-term yields have remained anchored. Bear curve steepening is one of the unusual non-parallel curve trends observed in history of the US Treasury yield curve movements. In fact, historical monthly data over almost 47 years shows that bear steepening occurs only close to 15% of the time compared to other yield curve shifts. Not only bear steepening occurs less frequently and lasts for shorter duration, but it is also rare to occur during the current stage of economic cycle. It is generally more evident during the recovery or the early expansion stage when growth and inflation both are rising and the Fed is in the later stage of easing cycle. So what has caused this recent bear steepening? The answer is a combination of factors which includes resilient US economic data, the return of higher for longer narrative, and rising concerns over US Treasury bond supply. We believe that the current bear steepening, a bond market anomaly during the current phase of economic cycle, is unlikely to last. Well, for it to last, we need to see factors of early expansion, where in addition to growth, inflation should also be rising. But long-term bond yields recently have been mainly driven by higher real rates, whereas forward inflation expectations have been unchanged. In fact, actual inflation data shows that inflation is declining rather than increasing. And not to forget, we are currently in the final stages of the Fed tightening cycle and not the beginning of the rate cycle. Past 6 Fed tightening cycles have shown that the 10-year US Treasury yield tends to peak before the final Fed hike of the cycle. Hence, we expect the US Treasury yield curve to mostly bear flatten till the last Fed rate hike and then start to bull steepen subsequently. While bond market volatility could continue until the markets get the timing of the last rate hike, but we expect limited upside in long-term yields. On the other hand, US high yield has benefited the most amidst the bear curve trend driven by rising rates. Since the beginning of the year, in 5 out of 8 months, the yield curve shifts have been driven mainly by rising rates. The asset class in general tends to do well due to its short duration characteristics and has even outperformed global equities in the month of August. Better cash holdings of US high yield companies and lower funding needs has even made the asset class resilient to tightening banking lending to corporates. However, we caution as risk remains, especially amidst the extremely tight valuations and the spread compression being near record lows. Overall, we expect that there is still limited scope for significant US high yield outperformance. As always, thank you so much for listening to our podcast, and we hope you find it useful. If you do, please share it with your family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log into our website www.adcbam.com. This is Prerana Seth signing off.